Thank you for joining us for our latest episode of the Talking Global Infrastructure podcast. I'm Harvey Chandler, Head of Policy and Public Affairs here at the Global Infrastructure Investor Association. In this episode, we'll be delving into investor thinking on everything from data centres to airports and looking at the relative attractiveness of Europe and the Americas, drawing on the results of our twice-yearly investor sentiment tracker, known to us as the Infrastructure Pulse Survey. We do the survey in partnership with Alvarez & Marsal, and I'm delighted to welcome three people from Alvarez & Marsal with us today. I've got Wayne Jeffson and Jay Moody, both managing directors in Alvarez & Marsal's transaction advisory team in the UK and the US respectively, and also Michael Farkas, a managing director with Alvarez & Marsal's tax team in New York. Let's jump right in here. Now, the survey's been running now since 2020, and at no other point has the USA as a country scored so highly in comparison to its peers in terms of the overall attractiveness of the opportunities investors see. Now, we know the opportunities presented in the Inflation Reduction Act, the Bipartisan Act, play a big role in this, with considerable supply-side support wrapped in to those two packages. Jay, let's start with you. Can you take us a little deeper and reflect on what it is that makes the USA so attractive at the moment?
I think it's a good market throughout the U.S. for infrastructure investment. You have a large market with some past underinvestment, plus a lot of change happening right now. Multiples, I think, have contracted some in many spaces as the cost of capital has increased. There are massive capital needs in the energy transition and communication spaces. Data center and fiber requirements are forecasted to grow massively as artificial intelligence continues to develop. And with that comes large, reliable, uninterrupted power needs that will be required as well. I think there's growing optimism in the communication space around the coming Broadband Equity, Access, and Deployment Program. That's abbreviated as BEAD. That's more than $42 billion of government funding that will be invested to expand high-speed internet access in the U.S. The BEAD program is the federal government's largest investment in affordable high-speed internet to date, which allocates money to states based upon the number of underserved locations. There will be winners and losers, I'm sure, but it's an exciting time to invest in the U.S.
Some food for thought there. I think the past underinvestment certainly opens up new opportunities when we think how the IRA and the Bipartisan Act play into considerations at the moment. And that $42 billion for BEAD certainly sounds like an interesting prospect and one I know we're continuing to monitor over in the US. Now, the survey looks at both the Americas and Europe. So, Wayne, let's jump over and look on the other side of the pond at Europe and particularly Germany and the Nordics, who score highest in the survey as destinations for investment. Now, this reinforces a long-term trend in the mind of investors. So what is it that's so attractive about these markets?
Yeah, thanks, Harvey. There's a lot going on in Germany at the moment, actually, in the metering space, and that includes roll-ups of sub-metering portfolios and a nascent market for domestic smart meters, with businesses looking for capital and positioning to take advantage of that rollout. And the smart meter rollout has been mandated in Germany and will pick up in 2025. There's also a need for increased energy security following the Ukraine war, and that's also creating investment opportunities in Germany. As for the Nordics, that's always been a strong market for infrastructure. There was a high level of activity in that country in 21 and 22 across a number of sectors such as ferries and district heating and energy transition. And actually, whilst activity's been lower in the last 12 months in totality than it was in that period, it still reflects a destination where investors would love to find more opportunities. It's seen as a stable area, stable geography, and it's easy to do business there.
Okay, now the energy transition, still a big driver there on activity, and there's also that call for more opportunity, something investors are calling for in both markets, if not all markets. Now, when we speak to investors about investing across the Americas and Europe and survey them, we see different observations of the investment environment. Are there any comparisons you would draw out in particular with the latest results in mind?
Thinking about it from a sort of European perspective, if you think where most of the investors in Europe have come from, they started their investment journey in infrastructure in UK assets and then expanded to Europe. They've always wanted to go over to the US, but the regulatory environment hasn't been there for them to do so, and obviously recent changes allow them to focus their investment in the US. So, Jay, I don't know whether you'd add anything more to that.
I agree, Wayne. We're a little bit behind in the U.S. compared to a lot of other places in the world that have had infrastructure investment in a larger scale for a longer period of time. And there's obviously just a lot of change and space in the U.S. where there is a lot of infrastructure needed. And that stability of having limited political interference and still a strong market, I think makes the U.S. an attractive area to invest right now.
Expanding this out, let's look at political instability, uncertainty around government direction as one of the barriers investors face. We've just come out of the EU parliamentary elections, with the governments of the European Union's two largest economies, France and Germany, taking a bit of a bruising. Now, taking account of those results and some of the conversations you've had since, are you registering a change in perception as a result of these type of political changes?
Yeah, that's a good question, Harvey. The survey was completed before the election results, so there's nothing coming out in the survey per se that points to any change in activity. And to be honest, I've not heard of any live processes that have been impacted by the recent results. That said, political uncertainty is definitely not a friend of deal activity. We saw this at the time of the last UK general election, as an example, when the political parties competing for government in the UK had vastly opposing views on private investment in infrastructure. Whilst this survey was completed ahead of these results, it's clear respondents were already seeing more political uncertainty across markets, notably the US and UK, which both have upcoming elections. Interestingly, that hadn't impacted the perceived attractiveness of the US, but it does seem to be a contributor to the UK's relative attractiveness. Ultimately, I guess it comes down to whether political uncertainty gives rise to policy uncertainty. And it's a potential for policy uncertainty that dictates whether investor appetite is high or low.
Let's look at the UK. UK, one of the largest markets for private infrastructure investment. We saw in 2022 the UK registering, very high scores here in terms of its overall attractiveness. After that ill-fated mini budget at the end of 2022, we've not really seen the UK recover. Why is the UK struggling to regain its position as one of the more attractive markets? And is there anything on the horizon we should be looking towards that may change that perceived attractiveness?
Yeah, I mean, you point to the Liz Truss mini budget of 18 months ago, and clearly that was very unhelpful in terms of perceptions of the UK. But that said, if we think about where we are now, many global investors have exposure to the UK across many sectors, and two of those sectors are the water sector and UK altnets. Clearly, there's been widely publicised issues of the UK's largest regulated water and sewage company and the funding issues it's facing, and also funding issues facing UK altnet fibre companies, and that doesn't help the overall perception of the UK. In terms of the water sector, water bills have been a political hot potato at the last two regulatory reviews, which, coupled with rising interest rates, index-linked debt, haven't helped the financial position of water companies. With the draft determinations for the next 5-year cycle now postponed until after the UK elections on the 4th of July, I'm actually really interested to see how Ofwat manages to triangulate the three factors that I think are key here, which are limiting bill increases to customers, allowing capital for much needed investment in ageing infrastructure, and allowing investors sufficient returns. I certainly don't envy their challenge in this respect. As for will things change, markets have already factored in a likelihood of a change in government and seem to be relatively neutral from that perspective. Targets for green investment have been watered down and policy is light on details, so we'll have to wait and see whether there is a step change in sentiment as a result of a change in government.
I think that's an important point there, that it seems to be that whilst the UK election outcome, if the polls are anything to go by, seems quite certain, investors still want to see some more meat on the bone in terms of the delivery of policies. And now let's take this up a level. What other barriers are investors facing beyond the purely political?
I think, as a tax professional, I think one of the largest barriers to infrastructure investing for foreign investment into the U.S. has always been U.S. tax policy. There are certain inherent frictions in the U.S. tax code as it relates to investment in infrastructure that's been around for a significant amount of time. I think one of those is obviously FERPTA, which creates a withholding tax problem. But just in general, with infrastructure investing and yield-based investments with lower margins, I think the withholding tax friction in the U.S. does make it hard for European money to be put to use in the U.S. and it's somewhat protectionist towards U.S. investment. But coming off of that, I would say, the clouds are starting to part a little bit in this regard. As historically, infrastructure investors had a hard time getting comfortable with our alternative energy structures. The IRA has gone a long way actually to clarify some of those things, and no longer needing Europeans to invest in what were very, very complex tax equity partnership structures that they had a very hard time getting their mind around, has actually created less of a barrier, I think, in the alternative energy space. That, along with just the certainty the IRA has created around alternative energy, has been a boon. Historically, the tax credit space was required to have extenders on an annual basis in order for the financing to remain in place. And given the amount of time that it takes in order to build these projects, that had been a significant overhang to investment. I think now with the IRA and some more certainty that these tax credits are here to stay, I think it really has opened up the doors to more solar investment.
So in addition to that, I think the barrier we hear most frequently mentioned is instability. Any form of instability makes an infrastructure investor who's deploying hundreds of millions or billions of dollars on a project very wary and unwilling to invest in a region. In the Pulse survey, when we asked about the key barriers when looking to invest, the most popular responses were unattractive regulatory regime and political instability / sentiment. I think it's pretty telling and intuitively makes sense. You don't want the rules of the game changing after you've deployed capital based upon the existing rules.
Jay, I actually think that's a great point, and I think that's where the IRA has done a lot to push the U.S. ahead. As I mentioned, historically, you'd had to wait annually to make sure that the rules weren't going to change. And I think with the government elections, one thing that's become pretty clear in the U.S. is that sentiment is that the IRA is here to change, even if there is regime change in the U.S. The unexpected or unintended beneficiaries of the IRA have really been pushed towards what we call red states, the Republican states, as there was a lot of incentive towards the old brownfield energy investment. And I think one of the helpful points of the IRA was that it really did benefit across party lines, in the fact that there was a benefit seen in many red states. So that the thinking is, even if we were to switch from a Democratic to a Republican regime here in the U.S., the IRA is probably here to stay in some form and fashion, which gives a lot of certainty, which has been helpful.
Some good points there, and I would just echo that point there that investors don't want the rules of the game to change once they've invested. That's really critical here. And when we think about existing and new investments and how changes can help or hinder one or the other, so we need to just make sure that this is considered more certainly. Now, this is our fourth year of doing the survey with investors and going out and gauging their sentiment. Are there any long-term trends that are notable over that period?
Yeah, let me take a first stab at that, Harvey. I guess 2 points that I've found the most interesting is as we've progressed across the 4 years, digital assets and energy transition has become an increasingly popular theme as big data and net zero have become the themes of the future. These asset classes, they naturally have more nascent assets, which in turn has led investors to take more greenfield and construction risk in search of the return hurdles that they require. That's one thing I found very interesting, and personally been very involved in a lot of digital and energy transition transactions over the course of the last 2 years, particularly. Another factor I find interesting is the rise of ESG as a key factor in infra fund investment decisions. If we look back 4 years, ESG was emerging as a consideration. Now it's clearly a very important aspect for consideration, and the majority of LPs require that the GPs consider this as part of their investment considerations. And that's changing the type and nature of investments that funds are looking at, aside from the general trend towards energy transition. At the peak of COVID, it felt there was almost a frenetic obsession with ESG, perhaps, and perhaps that was because of the level of assets in play that was so high, allowing funds to be very picky. This has settled down a little bit more recently, but ESG remains a critical aspect for deal teams to assess when deciding what assets to invest in. Jay, I don't know if there's any other key themes that you would pick up on across those periods.
I'll just add one thing. I think there's more and more focus on controlling capital expenditure cost. As you mentioned earlier, we're seeing a lot more greenfield type activity. So during COVID, supply chain issues, I think cost control was lacking, and it has come back into focus, especially as borrowing rates have risen, and cost overruns will eat even more into cash on cash returns. So I do think there will be a lot more discipline around greenfield projects and a lot more rigor, maybe with some outside help, on making sure that cost incurred on greenfield projects are in line with expectations and there aren't significant budget overruns.
Yeah, I think I would just add something that was said earlier. In the U.S., largely as sentiment relates to energy transition, I think we've seen kind of a perfection of that view that energy transition is here to stay, whether it comes with electronification of fleets and other kind of EV charging infrastructure. We were lacking pretty far behind Europe, I think, as it related to confidence that we were moving in that way. And I really say over the last 4 years, I've really seen that change drastically in the U.S. markets. I think that energy transition is here to stay, and it's going to be a very significant part of our economy in the go forward period. That coupled obviously with the digital infrastructure rise is probably the biggest things we've seen in the last 4 years.
Now, at a sector level, we see airports becoming increasingly attractive, certainly after that post-COVID period, that during COVID period where we saw revenues hit and a real kind of a bit of a shock to the sector, certainly. We've seen more activity in this space. We see it gaining traction. What is it that's driving this?
Yeah, sure, Harvey. I'll take that, at least from a European perspective. Look, there's clearly an emerging theme of pent-up airport transactions. The stronger airports in the last 12 months have seen traffic volumes return to pre-COVID levels. Whilst business travel remains somewhat subdued, leisure travel has certainly bounced back, and a number of airports are back to pre-COVID levels from both big ticket hub airports to some of the stronger regional players. COVID also facilitated restructuring of operations and activity, which otherwise may not have been possible, which means that many airports are actually operating with pretty healthy margins, albeit with more leverage than pre-COVID. The first major airport transactions have returned in Europe in 2024. We think of Budapest, Edinburgh, stakes in Heathrow, and those have traded at attractive multiples, and that's driven other owners who have effectively taken a hit over the COVID period and held their assets for longer than they otherwise would to bring those assets to market and see if they can attract those multiples. I expect to see, particularly in the UK, 3 or 4 transactions over the second half of 2024. Assets like Newcastle, stakes in Bristol, stakes in Birmingham, Rigby airports, and a couple of others have all been muted. So it'll be interesting to see what happens in the second half of the year in respect of those transactions.
Right. Okay. And are there any other sectors that stand out for you?
From a European perspective, clearly at the moment there are reduced levels of what we would call core infrastructure transactions. The key driver of that, other than some adverse sentiment towards the water sector in the UK, is clearly the fact that the interest rate environment is not helpful when interest rates are at 5.5%, and the associated debt is at 8.5%. That doesn't bode well for core infra transactions, which traded at high single digit or sort of 10% multiples.
I think Michael mentioned earlier the EV charging space. Electric vehicles have gone through a bit of a peak and a little bit of a downturn recently, just from a demand standpoint in the US. But I do think that EV charging infrastructure and all the related transmission distribution requirements around that are going to be important in the future. So I do think that's an area where we'll see additional investment, and maybe the multiples that are coming back down to levels that will get infrastructure investors more interested. And then there's data centers and everything around it. I do think that there's a huge need right now in the US for data centers. There's a fervor of interest around AI. The related data centers will need reliable power generation. So the traditional natural gas fired power generation and renewables and battery storage, which also scored very well in the Pulse survey, are going to be part of that energy mix. Hyperscalers are deploying capital for new sites rapidly, and the speed and precision in execution seems to be the most important factor, even more so than price. And so I think you're seeing a lot of activity there where private equity is trying to help with that build out as quickly as possible.
Yeah, Jay, and that's a great point. I think one thing I would just add to that, as well as, the difficulty we've seen in the U.S. in having new generation projects connected to the grid, has also created a strong demand for behind the meter energy generation. I think people understanding, obviously, these data centers and other technology and the need for generation is expanding, but the overhang in our grid technology is creating a real demand for behind the meter type of generation assets. And I think people are really kind of pouring some equity into that and realizing they're going to have to meet their own power needs.
I think that's exactly the same in Europe, although maybe not to the same extent as the US. Clearly, electrification in its broader sense, as well as the demand for data and the power requirements that has in terms of the needs of data centers, does definitely drive a need for behind the meter solutions to ensure grid stability and sufficient power. And there are a number of sort of temporary power providers that are potentially in the market, have been in the market, which I see will be potentially attractive to investors, whether they be infrastructure investors or others.
Wayne, I think it's a good point. I actually did a survey on my LinkedIn account probably several months ago at this point, and I asked what would be a larger driver of power needs in the future: the EV space, everything around electric vehicles, or AI and data centers. And overwhelmingly, the respondents said AI and data centers. But interestingly, I was at a conference where I knew the answer to this question from the experts, and the answer from the experts was actually that electric vehicle infrastructure was actually going to be a larger driver for power needs in the future. So I just found that interesting, right? I think there's a lot of excitement around AI right now. So it will be interesting to see. Both of them are going to be huge drivers in the future. But I do think the EV side of things has gotten less attention recently than data centers and AI.
When we think about this increased energy demand for things like EVs that you mentioned at the end there, an issue that often doesn't gain enough attention is the need for new grid upgrades, new grid infrastructure, and how governments are incentivizing this kind of core investment, this core infrastructure investment. Do you have any reflections on how governments are thinking about this?
I can take this one, Harvey. In the US, my perspective is for investor-owned utilities, they are always looking to increase rate base. And so I think that this provides a significant opportunity for much needed increases in rate base. So I do think that US utilities are very interested in building out electric charging infrastructure to be able to meet future needs and also ensure that they have a seat at the table rather than distributed generation where they're not in control of that power source in the future.
That's all we have time for. Thank you again to my guests. I would encourage you to go to giia.net for more information on the Pulse survey. You can also follow us on Spotify, Apple Podcasts, and certainly follow us on LinkedIn to know more about what we're doing and what's happening within the infrastructure investor sector. I'm Harvey Chandler. That was Talking Global Infrastructure. I look forward to seeing you on the next podcast. Thank you.